Financial mistakes. We all make them. Show me someone who hasn't made a financial mistake, and I will show you Rex Baxter here in just a minute. Welcome to a financial planning podcast with the down-to-earth vibe. Sasquatch listens while stomping out forest fires. This is Through the Pines. Now, on Through the Pines are our financial wizards extraordinaire. Rex up first. Rex and Dan here as well. And then we have Brandon in studio, Brandon with a Y and two cameras. Why, I don't know. So let's cover some financial mistakes, shall we? And I just want to say I'm good at them. Don't save. Get as much debt as you can as fast as you can, and invest in FTX. Rex, where did I go wrong?
A, B, or C.
A, B, or C. Okay. Yeah. Yeah. So what are some of the mistakes outside of those, like, the obvious ones that we know we should be doing, but and we'll talk about that in a minute, because there's some psychology there that's like, well, we know this is bad and we do it anyway, but that's different but what are some of the financial mistakes that people make in general that you've seen over the years, Rex?
Thank you for having us on your show, Brandon.
Yes. And please introduce yourself just a little bit, planwithbaxter.com. And just so people have some context, this isn't like your first year as being a financial advisor.
This is not my first year. This is my 25th year of being a financial advisor. And our team just received an award recently of being the number 2 on Advisor Hub's fastest growing advisors to watch list.
Oh. It means you guys run fast.
Mostly. I'm fairly confident it does not mean run fast.
Okay, got you. Okay.
And so if that was a funny running contest, we might be number 1. But but no. So we thought this would be a really fun podcast to do, and I could be mistaken, and maybe hopefully we don't make everybody feel bad. The nice thing is that there's very few mistakes that we've seen that can't be either corrected or course corrected or recovered from or something along those lines. And everybody makes mistakes, right? And it's okay. It's about who catches it the quickest, who makes the quickest course corrections, and who quits making the mistake, who doesn't repeat it.
So you've had people who've called you or come into your office or something, and they told you their situation, and you said, you did what?
Yes. But we do a lot nicer. Like, oh yeah.
Tell me about that. Yeah, I want to know about that. Like, what did they do, without naming names and all that kind of stuff? But like, what is stuff that you've heard that you're like, I can't believe they just did that? And I think we talked about something earlier where you said, maybe this is on the list, I'm going out of order here, where someone retired and they have access to their retirement funds, and they're like, hey, I just went out and bought a brand new car, and I bought this. So all that stuff's taken care of. Now, Rex, tell me what to do with my money.
Yeah.
Yeah. They'd spent like 60% of it, right? Because they went out and thought that it was the smartest thing in the world to go do on day 1 of retirement.
Yeah.
And so, it's always interesting. People, probably the most common, or one of the most common that we see after the fact is people taking money out of their retirement plans early and paying the 10% IRS penalty and not really looking at what other methods there are to try and achieve what they're doing. But that's probably one of the ones that we see so frequently. It's crazy.
And the car one, this gets back to being an advisor, right? We're on your side. We're not, if you want to do something that maybe doesn't make the most sense financially, we're right there with you, as long as you understand the decision. And I mean, the car one, right? Like,
so your job is to educate them, like, hey, right, I wouldn't recommend this, but
right. And I think,
yeah.
I think the car was more of like, hey, I don't want someone to tell me not to do this, so I'm going to do it. And then we're going to figure out how we make life work after that, which fine. But with the car one, it's like, if you would have just talked to us, we would have said, finance it.
Yeah.
And then and if you want to pay it off through your 401k, that's fine, but we'll do it over 3 years so we don't jump your tax bracket. You're going to be in these lower tax brackets your entire retirement, and we could keep it that way. But no, now we've pushed ourselves into a 22% bracket. Maybe we're paying an early withdrawal penalty. So there, we could save you $10,000-$15,000, just an extra $10,000-$15,000 if we just structure it slightly differently. You still get the car. You can still get the car now, right? It might not be the best decision, but we can make that happen, but save you substantial amounts of money in the process.
I'm assuming most people's mistakes are because they just don't know.
Yeah.
There's some who like willingly make the mistake on purpose. But Dan, what's the dollar amount of the biggest mistake that you've seen somebody make?
Oh, it's hundreds of thousands of dollars, frankly. Yeah, I think you're right. When I say they just don't know. And that's one of the mistakes people make. They think it costs a lot of money to sit down with a financial advisor and talk. It doesn't. It doesn't cost anything. With most every financial advisor I know, especially our team, it costs nothing to sit down for an hour, talk about your wishes, dreams, goals, what you're trying to accomplish, and then from there, design a plan. So the biggest mistake I see is people don't get help. They don't get help when they should get help. And if they would do that and design a plan, their lives would be a little bit simpler and wouldn't have to. I used to tell people, if you're in Salt Lake City and you want to go to Los Angeles and you get on I-80 and you start heading east towards Denver, at some point in time, you've got to stop and turn around, because it's not going to work if you keep driving east if you want to go to LA. So if you make a mistake, it's better to get the help, stop, turn around and say, okay, how can I fix this so that I can still achieve the goals I'm trying to achieve?
And then here's me. I'm like, I'm just going to drive east until I cross oceans and then come back on the other side. I'll get there.
You're not alone. You're not alone.
I'll make all the mistakes. Rex, let's pick on you because you're about as perfect as they come as making the best financial decisions in life. So getting personal, what is something you wish you maybe would have done better or different? Maybe it might not be a mistake necessarily, but something that you probably wish you would have done differently with your financials in your life.
That's a great question. I wasn't anticipating that question. That's a great question, Brandon.
I put that on the list, right? Did you not see that?
I missed that. I missed the memo.
I'm a little off script. Yeah.
I wish I would have taken. I wish I would have taken a few more financial risks, and this is going to sound odd coming from me, for those that know me, and from a financial advisor, but I wish I would have taken a few more financial risks in my 20s, whether it be with investment property, whether it be with saving more and doing more in the financial markets, things along those lines. And so I think if I were to look at it, I think I would have taken a few more risks back then.
Is there like an MLM company you wish you would have invested in, or what do you mean a few more risks?
No, there's not. I mean, there probably should be some, but but no, I'm not an MLM guy. I'm not that kind of. I don't enjoy those. That's not something that I enjoy. No, I mean, I wish I could I have bought an additional investment property or figured out a way to buy a duplex or something like that in my 20s. Probably. I probably could have figured that out had I tried a little harder. And so, things like that, and not that I've done poorly, I've done great. But there's things like that I probably would have done a little bit differently.
I'll be honest then, because while we're at it, Rex, you don't have to be the only one here. I invested in some real estate when I was in my early 30s, had a fourplex and a duplex. Actually, it was in my late 20s. And then because 2008 happened and everything was bad. And I thought the best way to resolve everything was to just sort of let them go. Also went through a personal divorce. And I thought to get them off the books and to get all that stuff just done with, I'll let them go. And man, do I regret that, because I think I paid $225 for the fourplex, and that thing's worth well over $500,000 now, easily. Right. And then the duplex was in kind of a crappy place in town, but real estate goes up. It's been like 15, 20 years or whatever. So I really regret letting that go. I had it tied to a business, and so personally, it hit my credit a little bit, but I sort of bumped out of that within a couple of years. So the kills me today is knowing all the equity I would have had I been able to figure out how to hold on to those properties.
Yeah, I and my guess is everybody has a few things to look back at, right? As far as, wow, if I knew today what if I knew then what I know today, I may have done, these things different. But I think that's where you can rely on, with Dan, 40 years of experience, with me, with our team, over 75 years of experience with our team, right? That we've seen a few things over those 75 years of experience, and being able to kind of talk you through the pros and cons, the good, the bad, the ugly, and understanding that at the end of the day, this is yours, your money, your decision, your life. And we get that, but we want you to make, educated decisions. We want you to understand the ramifications of your choices, and make sure that you're comfortable with knowing how different things may be impacted. And I think that's important. I think a good example of that would be, back in 2008, actually before 2008, when we had the market crash, right? We were working with some clients who had significant concentrated stock positions, and to where they have, millions of dollars tied up in a single stock. And we're having the discussions of, should we diversify it? And something you'll hear me say frequently on this podcast is that, concentration is the number one builder of wealth. And it was for this family. They'd owned, in this particular family, they'd owned this stock since the 30s, since the 1930s. And so it was kind of the thing to build it. But it's also
like
the
vampires, like they're very old. Yeah.
Well, I mean, it got passed down, right? From one generation to another,
I'm with you.
right?
Yeah.
But it's what built the wealth for the family. And here we are talking about diversifying that, protecting that wealth for the generation and the generations to come. And
all right, just to clarify, it was literally only one stock?
Yeah, literally one stock.
Okay.
Right? One company.
Multiple stocks of one company.
Okay.
Well, multiple shares of one company, right? But it's one company.
Okay.
And so anyhow, so we're talking about diversifying and all the reasons, and they're concerned about the tax implications of diversifying and what the cost of taxes might be. And in this case, at the time, the cost would have been roughly 15% of their gain, since they had inherited it. And that was significant. So we met with their accountant and their CPA, and the CPA couldn't get past the tax impact. And so the CPA's advice is, no, don't sell it. It's been a good company. Maybe it'll be a good company or not, but don't pay the taxes on this. Don't ever pay the taxes.
Okay. Well, so then is part of financial mistakes choosing a CPA that doesn't communicate well with your financial planner?
Well, I think it is having a team of professionals around you that are going to work together, communicate well, and understand their core competencies. My core competency is not taxes, right? I understand taxes. I get taxes. I pay a lot of taxes, right? All those things. And yet I'm not about to give you tax advice. I'll make sure that we're asking the right questions to an accountant and to a CPA, or on the estate planning, I'll make sure that we're asking the right questions to an estate attorney. But I'm not going to give you legal advice. I'm not going to give you tax advice. And by the same token, your attorney shouldn't be giving you tax advice. They shouldn't be giving you financial advice, right? They should help make sure you're asking the right questions. And so I think it is having a good, strong team around you. In this case, to finish the story out, 2008 happened. The stock went down 95%, and to this day has never recovered.
Wow.
Right.
What sector was it?
And so in this case, it was a combination of industrial and financial sectors.
Okay.
In this particular situation.
Wow.
And so, so that's a tough lesson to learn for somebody, and one that they can't recover from, that family will never recover from in that situation.
Was that millions, Rex, or hundreds of thousands?
It was millions, multiple millions.
Oh my God, that's so sad.
Right, terrible. And so I think when we talk about mistakes, we all kind of joke about it. We all kind of tell the stories and things like that. But I can't underscore the importance that this is a serious topic, right? This impacts people's lives.
Yeah.
This impacts decisions that they're going to make. And I think Dan's wisdom that he just gave of the biggest mistake he's seen is people not asking and coming in for advice, right? And asking the questions of, I'm considering doing this. What do you think? And that's not a hard question to ask.
So, yes. And then maybe I can get your guys' opinion because it's relevant to November 2022, and that is the FTX crash and all the red flags. So we're talking about FTX, but that's not the first time. I mean, Bernie Madoff ran a scam as well. And so are there things, but there were famous people that invested with this guy. And it was a house of cards and it crumbled very quickly. What are things that you as a financial planner, you guys as a financial planner look for when someone says, hey, I want to invest in this company or in this stock or whatever, that you guys can look at that you've seen over the years that you're like, yeah, I see red flags. Dan, is there something that you guys typically look for?
Well, yeah, they should have some type of a business plan. They should have some type of a track record. They shouldn't be smoke and mirrors. We've all seen that over the years in the late 90s when there was a lot of NASDAQ type stocks that had never made money. In fact, many of them did not even have a business plan, and they were trading on the markets before the turn of the century. They were trading on the markets for $100, $200 a share. And the famous words from I think it was the Fed chair at the time, we've got irrational exuberance out there in the market. That's kind of happened over the years in a lot of different situations.
Was that the Fed's way of saying like there's a bunch of crap out there, essentially?
I'm trying to remember. Was it the Fed chair, Rex?
It was Alan Greenspan, if I remember right, and it was a famous irrational exuberance comment at the end of '99, right before the .com bubble bursted in 2000, and essentially he was commenting because literally in 1999, 98, if you put .com after your stock's name, then it would almost go up 3, 4, 5, 10-fold, right?
I mean, I put a lot of money in rex.com. I didn't make it a thing.
Solid investment.
Yeah. Well, but this stuff happens over time, over and over again. Dan, you've been in the business long enough. You've seen this happen multiple times. What are some of those red flags? You said a business plan. I don't know how, is that public? Like, how do people just pull up business plans?
Well, yeah, a public company has to put together a business plan, and they have to have a CFO. Nowadays, we have all kinds of public companies have all kinds of rules and regulations that they have to follow in order. But the key to the whole thing is you don't put all of your money in one particular stock.
Okay.
Like Rex was saying before. Even if it's a great blue chip company, which in this case probably it was, you still don't do that. You still try and diversify your portfolio and put it in different sectors of the market, whether it's large cap, mid cap, small cap, international, maybe some bonds. You just have to diversify, and you only get that if you have the help of an advisor, and they put together a plan for you to follow.
So have you had clients that come to you and said, hey, I'm thinking about investing in A or B, and it threw up some red flags for you, or you're like, yeah, that's a bad idea?
Oh yeah.
Okay.
I have a really well-known person in my hometown that was offering way back when interest rates were 3 and 4 and 5%, was offering 10% return on their money. And I kept saying to a lot of my friends, a lot of my parents' friends that would come to me and say, "Hey, this is free money. I'm going to go over here and do this." And I would say, there's something wrong with that. If it was easy to do that, everybody would be offering 10%. And a lot of people in my hometown lost a lot of money. We've all seen those types of things in our business, unfortunately. And it gives everybody a bad taste in their mouth, because that's not right. You should be able to trust your advisor with everything that you do financially.
Yeah. Rex, how do you build trust with clients so that they understand and realize that you as a professional, it's in your best interest to make sure that they don't lose money necessarily. They don't make bad investments.
Yeah, that's a great question. I think trust is built over time, right? It's lost in an instant, but trust is built over time. And I think it takes those relationships some time to develop and for that trust to be established. Now a lot of times we're getting clients from a referral, right? That somebody says, "Hey, will you work with my mom and dad?" Or "Will you work with my business partner?" And then there's some implied trust, right? That kind of transfers over to you because you've worked with somebody that they know and trust. And then you start that relationship and it starts out with some trust, but you still have to build that over time. And at the end of the day, you need to say what you're going to do and then do what you're going to say and follow through and be authentic and be honest and upfront and then make sure that you're ethical and you have high integrity and all those other attributes that make for a good financial advisor. But boy, it can be destroyed in an instant and then it can't be rebuilt. And so, when you talk about trust and you talk about building those relationships, for our team, that is critical. And we understand, how quickly that can be destroyed and that we are dealing with people's lives and people's money. And these are, it's just so important. One way you can check, I know Brandon had put that in there, but in the financial advisory world, there's a lot of different regulators. And so, we get watched by many different government entities and reported upon. And so some of those is like FINRA, which is one of our regulators, and they have a site called brokercheck.com where you can look up a financial advisor and see if there's any regulatory issues or see if there's anything on there that needs attention.
Sorry, brokercheck.org, I believe.
You're right. Sorry about that. You're right, Brandon. Broker, what did I say? .com? Because we were talking about .com.
.com.
Right.
So Rex, and I keep going to this FTX thing just because it's new and it's in the news, but how did that, because like you said, there's so much scrutiny in your industry. How did that survive is that because it was in the crypto space? Like why did no one call that into question sooner?
Yeah, so I don't know the specifics of the FTX case. I mean, I know, kind of some of the fallout and things like that. My guess is that part of it is that cryptocurrencies are not highly regulated. And the trading platforms that they trade on are not highly regulated platforms yet. And they're getting there. And this will probably be the impetus to put through a lot of regulation. And so that, we'll see what the fallout is. But I think that's a big part of it, is that it's exciting, it's new, and everybody wants a piece of the crypto market. And there's a lot of risk there. And I'm not sure people understand how risky it is. And maybe this will open up some of those eyes that help people understand, just how risky these unregulated markets are.
Yeah, they just saw people making a lot of money and wanted in on it. And so, and now there's billions that may be gone forever. Brandon, you have on your notes here, and thank you so much for putting some of these notes together, that there's Social Security mistakes. And so it says, what is it really that traitorous? Well, that's a strong word.
Treacherous. That's supposed to be treacherous.
Treacherous. Oh, treacherous. Traitorous.
Traitorous.
Oh, wow.
Yeah,
Okay.
that's a bad one.
Treacherous. Yeah. What are some like Social Security mistakes? And so how do you screw that up? Because isn't that sort of automatic?
No.
Okay.
No, it's not. And so we're gonna take on this podcast, go through each rule of just kidding.
Wow.
Social Security. I mean,
Wow.
there's so many things. So we won't have time to go through all of them, or even brush the surface. But one of the main ones I've seen with Social Security is people don't understand the spousal benefit. And on more than one occasion, I've seen where, one spouse has worked, the other one has stayed at home and worked hard but not ever had an income. And so they just assume, well, I've never had an income, I've never paid into Social Security, therefore I don't get a Social Security benefit. But that's not the case. You depending on marital status and things like that, you qualify for a spousal benefit. And I've seen, like I said, on multiple occasions where couples have given up, $1,000 a month. And in both of those, they hadn't worked with an advisor. By the time we caught it, they came over to us and we saw they had missed out on over $100,000. It'd been like a decade. Now, when you file Social Security, they'll go back, they'll refund you for the last 12 months or so. But man, that's money that's just gone. And so that's one I always like to point out is spousal benefits with Social Security, whether you're married currently, or even if you were married for 10 years and got a divorce and then even they pass away, you're still eligible and can take benefits sometimes as early as 60. If not, you can take them later. You can switch which benefit you're on. I mean, there's a lot of complexities there, and you can't count on the Social Security office to catch all of those for you. And so that's why it's good.
They don't care.
They're good people.
Okay.
But man, there's a lot of complexities, a lot of things to look through. And so I think it's important, to make sure you're thinking through or at least talking to someone who can think through all of the different opportunities within Social Security. Because man, that's just heartbreaking, right? Because these people are usually not the people that can afford to lose $100,000, in retirement. And so Social Security is a big one.
One of the Social Security stories that we had seen at one point is the widow rule, right, Brandon? Is that, if you've been married for a certain amount of time and your spouse passes away, then you're eligible for Social Security benefits at age 60 if you meet certain criteria. And we'd had somebody meet that or come close to that. And then when they were 59, they decided to get married, right? They fell in love again. And who are we to stand in the way of love? Matter of fact, I think we've had a podcast on this.
Yeah.
Right. And anyhow, got married at 59. Had she waited till 60 to pull the pin on that, she'd have been entitled to a couple $1,000s a month of additional Social Security.
That just fits those because we didn't know. They got to reach out. Completely. Why would you think to call your financial advisor because you're getting married?
Yeah.
Because it deals with a dollar. If it deals with a dollar, we're involved in it one way or another. And so
I had one where she was married 9 years and like 9 months, and the cutoff is 10 years to be eligible for that benefit. And it's just one of those things where just delay the divorce paperwork for 3 months and keep eligible. In this case, I don't think it made a huge difference, but man, it can. Yeah. I mean, that can mean the difference of $1,000 more per month for the rest of your life.
Yeah. Okay. So this is one, I think this is sort of the next question or the next thing on the list here. And that is, what would make sense to me is that when you're young, in your 20s and 30s, call that young, can happen in your 40s, and you start a job and you get a 401k, but you don't ask for advice and sometimes they'll send in people to say, we have Susie here and she'll help you figure out your 401k needs or whatever, but you don't ask a financial professional or have the full picture of what it is that you want to do. And then you don't look at it again for 20 years. And you've lost so much money because you were invested incorrectly. Dan, have you seen anything like that?
Yes, we've all seen everything like that. The key to that, if you're in your 20s and you work for a company that has a 5% match, the most important thing is that you're going to take 5% of your paycheck and put it into that 401k so that when they match, you have 100% return that year. and every year going forward. And then the second thing is to make sure you invest it properly and diversify it properly. And that's where you get the help from a financial professional. But for sure, start early, save that money, and don't give up. If your company is a great company you're working for and they're matching whatever you put in the 401k, make sure you do enough to get that full match. That's key.
Okay. Rex?
Yeah, I think, we've all seen, like Dan said, we've all seen situations where people ask their neighbor or their coworker about how should I invest, and they're either significantly older, significantly younger, more aggressive, more conservative, and have had different life experiences that may shape or bias their opinion on what you should do, and that doesn't always match what's best for you. And so I think using an advisor to go through and look at how the 401ks are working, both in and of themselves, but also in conjunction with your broader picture, with your overall asset allocation, I think is extremely important. I think the other thing I've seen on occasions on retirement plans like that is that sometimes when people are changing their jobs, we just did that podcast of the decade of your 30s, is sometimes they don't take into account the 401k match as a benefit, and they may end up going to a different company that doesn't have a match, and they're thinking that the grass is greener when sometimes it's not. And sometimes the money that you're getting in benefits is just as important as the money that you're taking home in your wallet. And so I think that's important. I also think that sometimes keeping things consolidated. We went through an example here recently where we were tracking down a pension, an old pension from 25, 30 years ago that a client had, because they'd left it there and lost sight of it and had forgotten about it. And all of a sudden they just offhanded mentioned something to us that, I wonder if I have anything there. And so we dug into it, and lo and behold, we found it. And there was some money there that was theirs that we were able to track down and get over to them. And so if you don't keep things together, and then it's easy to lose sight of it, and it's easy to forget about it 10 years from now.
Rex, you mentioned that you may have taken more risks as you were younger, but let's talk about taking too much risk. And usually you're more apt to do that when the going is good, right? So like the late 90s, we're sort of coming off of most recently a bull market that ran for a long time. When you watch other people make a lot of money and you want to do what they're doing, you want to see those same returns. And so the market tells us over a certain amount of years that it would average a certain amount, but Jimmy down the road's making double that and has for 25 years. And so I want to invest in what that person's investing in. Rex, how do you keep your clients sane in bull markets and in investing properly and not over risking their assets?
It's really difficult sometimes because, people near market tops, whether it be the financial markets, real estate markets, like you said, when everything is going good, people want to take more risk. And typically that's at the top of a market. And so, we always kind of jokingly say that it's the, give me some of that syndrome, right? And I want whatever doubled last year is what I want to buy a bunch of. And that's typically one of the more, the poorer investments that you can make, because you're buying high instead of buying low. And I think Warren Buffett probably said it best of, that I'm greedy when everybody else is fearful, and I'm fearful when everybody else is greedy. And people are greedy at the top and they're fearful at the bottom. And you want to, in big picture, you want to kind of do the opposite of that. And I think the best way that we have to work with our clients is through showing examples and talking to them, and sometimes, showing them charts and showing them pictures of what different markets have done during different times. Now, we do that, and every time it's slightly different, right? The facts and circumstances of this market top is different than the facts and circumstances of the market top in 07 and 99 and 86 and keep going back. Each time it's slightly different, and what causes the market downturn each time is different, right? One time it might be oil embargoes, one time maybe a president is shot, one time it may be a real estate crash, and so the facts and circumstances are typically a little bit unique, but the patterns and the cycles tend to fairly commonly repeat themselves. Now, the highs may be different, the lows may be slightly different, the length of time may be slightly different. But the general pattern is typically fairly similar over time.
Okay. Well, and the opposite of that is not daring to take any risk. So, Dan, how do you convince people to invest or take a little bit of risk to earn a decent return?
Well, it's a process. It is a process. Let me tell you something that I think is really, actually, because it's kind of comical actually, but over 40 years now, as I've been doing this, I can't tell you how many times I've had somebody say to me, and this is how they start out their sentence: my brother-in-law,
Yeah.
my barber,
Right.
or
Right.
my dentist, or this is what they're doing. And when you said something like Jimmy down the road has gotten 25% per year, usually Jimmy's not telling you the whole story.
Sure.
I've noticed that over the years. So keep in mind that we all have great brother-in-laws, we all have great dentists, we all have great barbers, but usually they're not financial experts. And usually by the time they tell you about something, you're right within 10% of the top. And so be careful with that. Proper diversification. It really is important to buy low and sell high. But by diversifying in a good portfolio and having a financial plan in place to determine what that portfolio should be based on your own investment objectives, not Jimmy's, not your brother-in-law's, not anybody else's, but what are my risk tolerances and what are my investment objectives, and get an advisor to help you. And this team, Rex and Brandon, they do a great job at that. And that's the key to investments going forward, I think.
So then, with that said, Brandon, how does having a financial plan help prevent mistakes in the future, financial mistakes?
Yeah, financial plans, the best built portfolios are built on a good financial plan. And the purpose of that is because everyone's needs are different from your portfolio. And I get that all that, people know I'm a financial advisor, and they'll come up and say, "Hey, Brandon, what should I be doing? What would you do if?" And the answer, and you'll appreciate this, is it depends. Right?
Yeah.
Like what's your time frame? When do you need this money? And then when you start to need the money, how much are we going to start pulling on the portfolio?
Yeah.
Right? All of those things, that is key and fundamental to building a portfolio, because whether the markets are up or whether they're down, we can't predict perfectly what's going to happen going forward. Right? You cannot tell what's going to happen. And so you have to build a portfolio that's going to be able to capitalize on market upswings and compensate for inflation, compensate for all those other pieces, while also having enough in safer assets that will be able to make it through a downturn, that will be able to distribute money without hemorrhaging. And so the answer is it depends, but a financial plan allows us to back into that and say, all right, here are the assets we have. Here's what we're living on today. If we retire in 5 years or in 4 years and we've got Social Security offset this, how much do we need to pull from this portfolio? And then from there, we can determine how aggressive to be. We can also look at various rates of return. Are we comfortable going for higher rates of return and taking more risk, having more ups and downs? Or does that make us nervous, and do we need to be a little bit more conservative? Obviously, right now, when we're in these tumultuous markets, clients will say, well, I don't want to ride this in, I don't want to ride this out anymore. And so the obvious question becomes, well, okay, then what's our retirement plan, right? Do we want to change our retirement assumptions to where we're only going to get CD rates and assume a 2% rate of return or whatever the, long-term average is going to be? And if that doesn't work, we can't have a plan where every time the market crashes, we sell out at the bottom, move to cash in time to, miss the upside. And so planning really is foundational to understanding how to invest a good portfolio.
Rex, I didn't think about this, but I guess you guys do get asked questions from everybody you know, or everyone who finds out that you're a financial planner. And so, how often has someone come up to you and said, I'm thinking about doing this, and you're just like, you're not a client, but that's a really bad idea.
Frequently.
Oh, wow. I didn't know that.
I was golfing yesterday for a few minutes, and two things
down
kind
where you are, but yes. Okay. Yeah.
So two questions came up. I mean, a lot of other questions came up, like, Rex, why do you golf? But two financial questions came up, and one was, Rex, I just bought ABC stock. What do you think? Well, I mean, that's kind of a loaded question, right? Because I have no idea what else you own. I have no idea how that fits into your portfolio. I have no idea, anything about your planning or anything like that. Mm-hmm. And so those are tough questions to answer. It's just like, well, I don't know. It might be a good stock, might be bad stock. It might fit into your plan. It might not fit into your plan. I'm
assuming they really don't like that answer.
No, they want, well, one, they want validation, right? Number one, they're seeking validation.
Yeah.
They want to know that, the stock that they bought was the right stock at the
greatest
right
stock ever. You are my hero.
Right.
I'm going to come to you for financial advice from now on. That's what you're supposed to say.
Exactly. Yep. You should just keep doing it on your own. So that was the one. That was one of them. The other one was kind of an admission of, Rex, I made a couple of poor financial choices late in life, and now I'm starting a business. I'm having to start a business. And in my, in this case, it was in my mid-60s. And, what do you think of that? And again, it comes down to, I don't know, without looking at all your financial numbers to see, what your plan looks like, how much you're going to spend on this adventure, what's the outlook going to be. It's hard to say. And so typically those are the kinds of questions we're getting when we're just out in the public, and it's such a small piece, and we're not a pushy group. And so, typically we'll say, I'd be happy to take a look at that. If you want to talk, I'm happy to give you a call or reach out to you, and we can kind of go through it. And then we can look at it and see what you really think. But most of the time they're looking for validation that their idea is the greatest idea since sliced bread. So,
yeah. Brandon, I was going to say, Brandon, early in my career, used to get these questions all the time. And you as an advisor, you try and be an advisor, and that's hard when you know nothing about the history and, anything about the investment objectives of that particular client. 10 years ago, I would just pass it off as, well, it's just a question. It's just a question and move on. The last couple of years, I've often, with friends that have asked me that, I've often looked them straight in the eye and said, I can't believe you did that. That's a piece of crap stock. And then walk away. Yeah. And then walk away. And interesting to see how they change. Hey, Dan. Hey.
Yeah. I like it. I'm with you, Dan. I just keep doing that.
That's a good strategy.
I like it, Dan. I'm glad you shared that. I may have to try that once or twice.
Then we'll do a podcast on it. We'll do that every time someone.
Yeah.
Just kidding. For next month. I was going to add, so because we get those questions, and I like to lean on research, and at any given time for most stocks, we can actually pull up, 3 independent reports that each report had a team of analysts on it. They're looking at the fundamentals, they're looking at the patterns, they're looking at the insider trade. I mean, they're looking at everything on these stocks. And it's funny because we'll pull up these reports, usually all run within the last few days. And any one stock can have one set of analysts saying this is a buy, and then another set will say, no, this is a sell, right? Like people, like
100%. Yeah. I'll watch the financial news and they'll have two guests on in literally at the same time.
Right.
And they'll bring up a stock example, and they'll say, all right, are you buying Tesla? And the one will say, yeah, I think it's at a good buy-in rate right now. And another one will say, no. And here's why. And so if your friend buys a whole bunch of Tesla and they come to you and they say, hey, I just bought a, how are you supposed to answer that?
Right. And ultimately it comes into how are you building a portfolio? Understand you have to know what you know. And it's also important to know what you don't know. And that's where people get uncomfortable, because it's uncomfortable for us to understand every piece of our portfolio. And so understanding that we can't predict the future, we can't predict the future of any individual company. Therefore, we're going to diversify. We're going to have it in several different sectors, right? There's strategy behind that, but we're not going to try to like predict who's going to come up with the newest, nicest electric car or plane or whatever it is. And understand, just invest based on what we know. And that works so much better than the speculation. But the speculation feels better because you get in your head, you're like, this is what's going to happen with this stock, and you just think it's going to take off. And so
but that's one of the biggest mistakes we see, right? Is that all of a sudden grandma hits a home run on a stock, she buys it, it goes up a bunch, and then all of a sudden they think that they're an investment guru, and they confuse a bull market or some market event that impacted a stock. They confuse that with actual investment knowledge and an investment strategy. And so what happens on the second one is lots of times then they get really daring and they put a lot of money into their next hunch, and they buy a bunch, and it goes down a lot and it eats their lunch. And so anyhow, that's something that's a big mistake that we see a lot of. So
was that alliteration? That was bunch.
Yeah, he did really. Did you have some more numbers? I forgot to get some more numbers on this.
You bet.
Yeah, let's do some more numbers, and then when we come back, I have breaking news: the biggest financial mistake you can make.
Excited for that one.
Yeah.
So since 1982, the U.S. population has grown by almost 45%.
Since when?
1982.
Wow.
45%. That's a lot more people.
Yeah.
You know,
and right now we don't know how many people are here.
Yeah, we've got a lot.
Yeah.
In that same time frame, homes for sale.
Internet again. I was looking.
Yeah, stay with us here for a second.
Hey, come on, internet. I was home listings are down quite a bit right this second.
Yeah.
Right?
Yeah. They're down a lot. And so, and I don't know, there's, good, bad, but it's that's what's making it hard is you have way more people all bidding on far fewer homes, and then you have the interest rates that throw it off. And so anyway, it's a complex issue.
So I think we may have lost you left us on a cliff, Brandon.
Oh, I did? Oh.
So total U.S. population's grown by almost 45%. And then what was the second half of that?
Oh, go ahead, Brandon.
In that same time frame, available homes for sale have declined by almost half. FactSet did that research and put a chart together. So, I mean, it just illustrates why it is so. Our housing market is in a really hard place, and when you have that much more population and yet so many fewer homes for sale, that makes it tough. And this isn't a new. I mean, you go back, really the last time it was kind of in check was more, 2008 time frame, right?
Yeah.
But in the
have you guys seen, are builders making money?
A lot of them have slowed down and are starting to kind of rein it in on the building a little bit. A lot of them are a little bit nervous with higher interest rates to see what that is. And that's kind of a continuation from 2008, that it took them a couple of years to really start building. And then they were just building, one or two or a couple of homes at a time. And they kind of have kept that for quite a while. And now they may be cutting back on a home or two even, as far as starting it to kind of see where this economy goes.
But Brandon's stat, though, I mean, you would think like that's a good opportunity to build a lot of homes because it seems like there's a need.
Yeah, and there is, but with financing, I mean, if people can't afford to buy the house, that throws, but I think I'd also use that stat to understand there's likely a very good pent up demand that isn't just going to be solved. And so, this interest rate, adjustment that's going to make it hard to buy homes. But But getting back kind of to our 30s podcast, it's a good idea to buy a home when you can afford it, because I don't know that affordability gets much better, down the road. Maybe when interest rates come down, but when interest rates come down, you tend to see house prices jump back up.
Yeah. Okay, so I have the secret. The biggest mistake that people can make with their money is, correct me if I'm wrong, financial planners, not having a plan. Like not having a plan. If you don't have a plan, you're going to make mistakes. Rex?
Brandon, you're so close to nailing it. So close. I can't believe you get down to the 1 yard line of
I was like right here. Yeah.
You were so close. The biggest mistake people can make financially is not talking to
a financial planner. Well, that's what I meant. You got to have a plan, but in order to have a plan, you got to talk to a financial planner. Yeah.
In our opinion.
So in our humble,
in our opinion, our humble, unbiased.
But really, I mean, if you don't, I mean, it's the same with goals, or same with anything in life. You don't have a plan, then you're just wandering around. But if you don't have a plan, then you're spending money and you don't know where it goes, or even if you're still putting 10, 15% away, but it's just going in savings, you don't have a plan, you're losing money. So Dan, what's the best way to start a plan?
Get with somebody that you trust. This team, we have great tools to help anybody that has an interest in saying, okay, I want to have a plan for my life. I've got 20 years or 30 years or even 40 years to save this money to prepare for retirement and leave a legacy to my kids, my grandkids, and great grandkids. And so you get started that way. You got to find somebody you trust. I want to go back for a second to the brokercheck.org. I can't tell you how important it is that you get with a person that's reputable, that hasn't got a whole bunch of client complaints against them, that hasn't taken out bankruptcy themselves as financial advisors. Believe me, there's guys out there that are financial advisors that have taken out bankruptcy themselves, which doesn't seem right to me. But you should be able to go in there and look at that record, because there is a full record. And you can tell real quickly if that's someone that's got 10, 11, and believe it or not, I was trying to, before I hire people in the business and bring them from another firm to our firm, when I was a manager, I would always look at their record. And there was one person in Utah that has 11 complaints from 11 different clients. Shocking. Believe it or not, I didn't make that call. So you need to make sure you can trust the person. And by checking out the history of that particular advisor, you have a little better trust.
That's all public information then at that website?
It's just a website.
Yep. www.
And check mine. You can check Rex's and Brandon's, any advisor that you know, brokercheck.org.
Brandon, how much money can I lose by not having a plan?
All of it. I don't know. I mean, it goes back to those examples we were sharing, right? Of people who leave a 401k or an IRA sitting in cash for decades and coming back and realizing it could have been double or triple, missing out on a Social Security strategy, just completely missing a benefit, selling at the bottom. There's a lot, that you can do. And most of those mistakes could be solved by just simply asking the question. If all it takes is a conversation with someone that can ask you the question, and most times people kind of can get through it, right, and can answer that question. But unfortunately, most of the mistakes are just because people didn't know to ask the question in the first place. And so that's probably the biggest one, is just talk to someone who can probe for questions. Yeah.
Rex, you're a pretty positive guy. If someone made all the mistakes their whole life and they're approaching retirement, and you're going to tell me there's always still time, how do you know that? How do you know someone can come back from making all the mistakes and just like, you know what? There's still something we can do for you.
Well, we'd put our arm around them, right, and we would comfort them and give
him a bro hug. Yeah, okay.
Give him a bro hug. I think even though we say that you can recover from everything, it may not be 100% recoverable, right? You may, if you make certain mistakes, you may not get back 100% to where you wanted to be as far as on track. And so I think it's important that we look at that. And again, you'll have choices. If you're planning on retiring at 65 and something happened and blew up, you went through a divorce that kind of blew up your finances, or you changed jobs in your early 60s that was a little bit costly and had to move and relocate, then we probably need to look at those numbers and see what that looks like. And does that mean we can still retire at 65, or does it mean we need to push through to 66 or 67? Or does it mean instead of spending $5,000 a month, we spend $4,500, or whatever whatever those questions are? It's running through the scenarios, running through the variability of returns and seeing what impact that may have. Does it mean we get more aggressive at that point to see if we can get there, understanding the risks are that if we're wrong and you're more aggressive, that it could handicap you further, right? And is that a risk you're comfortable taking? But going through that with somebody and going through it with a partner, I think is a lot better than trying to go through that alone. And there's a lot of studies that show that if you go through, active financial planning and active goal setting and things like that, that you're a lot more likely to hit your goals and to be able to achieve those goals than if you don't. And so I think we're just trying to put the probabilities in your favor and trying to help you down the path and share our experiences and knowledge and wisdom with you.
Yeah. Dan, Rex, Brandon, thanks so much for your time and sharing some of the mistakes that you've seen in the financial industry over the time that you've been in it. If you haven't already and you're listening to this podcast and you haven't subscribed to our YouTube channel, I highly suggest that you do so that you could see our wonderful, beautiful faces on our YouTube channel. It is Through the Pines on YouTube. That is it for this episode of Through the Pines. We'll see you on the next one, where we will remind you to use yesterday's dollars to finance tomorrow's dreams.